Come on. This YouTube is always fun. It's so hard to start the YouTube. I have to like go to an incognito and sign in. Oh, it worked. Okay.
Cool.
We are good there. Make sure I get the sound off. Okay, cool. Okay, so today we are doing options trading, which I have a little experience with. I did this back in 2016. I was doing this full time for like 3 months until I got my company up and running, and then I didn't have time to keep doing it. But I wanted to break this down. So, episode 47, we had Cam Desani on talking about his options trading strategy and his basically trade with me program that he has. And I just wanted to go over a like real basic options trading 101 for people that may not be super familiar with it. Um, and we've got Freddie on the call today. He's going to be asking any questions you have and going over this. But when I learned to do options trading, it was very foreign to me. I had no idea what it meant. I watched a bunch of YouTube videos and I had to watch a lot of YouTube videos. And there was one that I watched that just like clicked for me and I finally got it and understood the whole concept and how it actually worked and how to leverage it and make money with it. I couldn't find that video. This video was a long time ago. I don't know if it's still even up, but I do have a video that I want to start with. It's a short 8 minute video and it explains where the purpose of options, where they actually come from and why they exist. Um, so I do a lot of real estate and options also big in real estate because you can um, have an option to purchase a property at a set price. And so it kind of works the same way with stocks. But this video does a really good job of explaining how the process works and why it works.
Did I hear you right? You said that there's even one there's in real estate? Really?
Yeah, so you can do, I've never done an option, but have you ever heard of a lease option?
Okay, yeah, yeah.
Yeah, so basically a lease option is where somebody has a house and you want to buy it, but you don't have maybe the down payment right now or the credit or whatever. You're not able to buy it right now. So someone will do a lease option, meaning they will lease the property to you and you pay a fee. You pay an option fee up front. So let's say it's a 2 year option and it's, $3,000 is the fee. And then you pay monthly rent for the next 2 years. At the end of 2 years, because you paid that $3,000 fee up front, you have the option to buy that property at whatever price was predetermined at the time you signed it. So, if you go through the 2 years, you get you got some money saved up for a down payment to be able to finance with the bank and your credit's better now or whatever the situation was holding you back before. Let's say you're able to buy it. Now you can buy that property at that predetermined price. So if it was a $500,000 purchase price, and then let's say 2 years go by and there's been a bunch of appreciation. Now the property's worth 600,000. You still get to buy it at 500,000, and now you've got $100,000 in equity because you paid that $3,000 up front. Now you don't have to buy it if the house is, you know, regardless of what it's worth, if you're not able to buy, you're not locked in, you can walk away, no big deal. You lose your $3,000. But if the property goes down for some reason and the property is only worth 400,000 and you're like, well, shoot, I don't want to buy that property for 500,000 because that's what the agreement was for. You just walk away. You lose the 3,000, but you save yourself from walking into a negative $100,000 equity situation. So it
Yeah.
gives you options. Options with stocks is very similar in how it works. So there's not a whole lot of differences. But let me actually, I hope this video is going to play. I don't actually know if it's going to work. Let's see what happens here. Can you hear that? Do you hear the video playing on that, Freddie?
No, no, I don't.
You don't hear that? It's a
No.
sound. Well, well, shoot. Okay, now I got to figure out how this actually works. Share sound. Oh, I got to click share sound. Let's try that. All right.
So the method I'm going to teach you afterward will
Okay.
be even
Yep.
easier for you to apply.
Okay, so this is just an 8-minute video. We're gonna walk through it, and then I'll probably stop it a few times and just kind of go over it. But this will give a good overview of where options come from and why they even exist. And then we'll go into the options trading strategy, so you can really break down how this strategy works and how you can
with
fix your
options.
company.
Okay, here we go. So Susie's selling her house for $500,000 in a neighborhood that has a nearby parcel of land that is for sale as well. There are two parties interested in the land. Peter plans to develop the land into a beautiful park and bird sanctuary, and Harry plans to build a low-cost housing development. Now, Sammy comes along and is interested in buying Susie's house for a cash deal, but he has a problem. He won't have the cash available for 3 months. So he's, of course, worried that the house will be sold to someone else in the meantime. So he decides to offer Susie $5,000, or the option premium, right now, if she'll take the house off the market and give him the option. This would be a call option to buy the house for $500,000, which is referred to as the strike price, anytime within the next 3 months, which is the expiration date. Now, if he does not elect to buy the house, Susie keeps the $5,000 premium and Sammy walks away from the deal. If he does elect to buy the house or exercise the option, Susie still gets to keep the $5,000 and he pays her $500,000 for the house. Now, 3 things could happen in this story. In scenario 1, Peter buys the nearby parcel of land. This, of course, will increase the value of Susie's home to, say, $600,000, in which case Sammy will be very happy to exercise his option to buy the house for $500,000. In scenario 2, Harry buys the nearby parcel of land. This, of course, will decrease the value of Susie's home to, say, $400,000, in which case Sammy will not exercise his option to buy at $500,000, and he'll just walk away from the deal having lost only $5,000. Then there's scenario 3, where neither party buys the nearby parcel of land. Susie's house is still worth $500,000, and Sammy can elect to exercise his option to buy the house for $500,000 or not and simply walk away from the deal, losing only $5,000. In effect, Sammy is controlling a $500,000 asset for 3 months for only $5,000. No matter what happens during that time, the most he can lose is $5,000. Susie, on the other hand, is happy to take the $5,000 as she had no guarantee anyone else would buy the house at her asking price, nor did she feel the nearby parcel of land would sell anytime soon. Here's a footnote to the story. Depending on the circumstances, if Susie felt she was likely to attract another buyer in the near term, she would have demanded more than $5,000 from Sammy to take the house off the market for 3 months. Likewise, with call options, the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. So now let's define this in trading terms and look at an actual example trade. A call option is a contract between 2 parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the call, has the right but not an obligation to buy the stock at the strike price by the future date, while the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example,
Okay, so I just want to stop this real quick. So basically, what this option does in this house scenario is very similar to stocks. It's giving you the opportunity to control the asset without having to pay $500,000 for the house. You're only paying $5,000. So for a very small percentage, 1% of the purchase price, that buyer controls what, in this scenario is 3 months. They control that asset. So if it goes up or down, they have the option to take the profit if it goes up, or if it stays the same, they can buy it at that price, or if it loses money, they have the option to walk away. So instead of putting up $500,000 to buy the house, they now control that asset with a very small fraction. So it's really about control. You don't own the house, but you own the right to buy the house. And so that right is what creates the value. So that's how options is a way to control assets or control stocks without having to have all the cash in there. So now he is going to go into an actual example with a stock.
For example, if a stock is trading at $50 and you think it's going to go up to $60, you might buy a $55 call option for, say, 20 cents. If the stock rose to $60, that would allow you to buy the stock at $55, even though it's valued at $60, netting you a $4.80 profit on each share. On the other hand, the person that sold you the call would be obligated to sell you the stock at $55 at a loss of $4.80. If the stock never rises above $55 by expiration date, the call expires worthless, and the call buyer is out 20 cents and the call seller keeps the 20 cents. Okay, now let's look at how put options work by revisiting Susie and Sammy from our earlier story. Sammy owns a truck worth $40,000. He's concerned that his truck might be damaged in an accident or even stolen. So Sammy decides to buy a zero deductible insurance policy, or a put option, on the truck for the full amount of $40,000, which would be the strike price, from Susie's auto insurance company. Susie charges him $1,500. That would be the option premium for a 1-year policy, 1 year being the expiration date. Now, 3 things could happen in this story. In the first scenario, Sammy's truck is not damaged or stolen during the year, so Susie keeps the $1,500 premium. Sammy's okay with losing the $1,500 for the protection it provided him for the year. In scenario 2, Sammy's truck is damaged in an accident, requiring $10,000 in repairs. He exercises his insurance policy, or his put option, by filing a claim, and Susie pays him $10,000 for the repairs as agreed. Sammy is happy he purchased protection for this possibility. In the third scenario, Sammy's truck is stolen. He exercises his insurance policy, which is his put option, and files a claim, but this time for the full replacement value of his truck, and Susie pays him the full amount of $40,000 to buy a new truck. Sammy, of course, is very happy he purchased protection for this possibility. In any case, Susie's happy because she sold many such insurance policies, different put options, to other drivers, most which never filed a claim or never exercised their options, providing her with a net profit overall. And here's a footnote to this story. If Sammy had a poor driving record, that's more risk to Susie, so she would have charged him more than $1,500 for the 1-year insurance policy. On the other hand, if Sammy had an exemplary driving record, Susie could have charged him less, as the risk would be lower. Likewise, with put options, the higher the perceived risk, the higher the premium demanded by the market. Let's look again at a definition and a trading example. A put option, then, is a contract between 2 parties to exchange a stock, or an ETF, at a strike price by a predetermined date. One party, the buyer of the put, has the right but not an obligation to sell the stock at the strike price by the future date, while the other party, the seller of the put, has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go down to $40, you might buy a $45 put option for, say, 20 cents. If the stock dropped to $40, that would allow you to sell the stock at $45 even though it's valued at $40, netting you a $4.80 profit on each share. On the other hand, the person that sold you the put would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the put expires worthless and the put buyer is out 20 cents and the put seller keeps the 20 cents. Thanks for watching this video. And
Okay. So that kind of covers like the idea concept. Let me get back off this here. Sure. I can never figure out how to stop sharing on these things. My screen. Oh, there we go. Okay. So that kind of gives an overview of what, like how an actual option works, or like where they come from and what the purpose is of it. So where do like options actually come from on stocks? Why do people do this? So usually this is going to be like an institution that has a bunch of stock. Let's just say a large hedge fund has a bunch of Tesla stock and they're just sitting on it waiting for a future price that they think is going to go up to whatever. What they can do is they can write what's a covered call. They can write a covered call on these and sell options and be like, okay, we've got all this stock here. We will sell a call option to somebody at this price in the future, and basically gives them a way to make money on the stock that they're already holding rather than just sitting there waiting for it to go up. Let's say it's I think Tesla's trading at like 415-ish right now. Let's say they sell, they think it's going to go up, but it's not going to hit 500 by the end of the year. So they'll sell a December call option for 500, and they don't think it's going to get to 500. So somebody will buy that, and then let's say it gets up to 475, and then so the other person's going to let it expire worthless, right? Because it didn't hit the 500, so that person lost out, and they're not gonna buy a stock for less than they're not going to pay $500 for a stock that's worth 475. So let's say it hits 475 by the end of the year. So they're going to let it expire worthless. And that premium that they collected on that is money that they get to pocket. And at the same time, the stock went from 415 up to 475. So they made money on holding their stock as well. So they just made money in two ways by selling this option on that stock. So that's kind of where these options come from and why they're floating around. And there's a lot of them. You can also do that's called a covered call when you own the stock. You can also do a naked call. And I don't want to get too much into these terms because it doesn't really matter for what we're talking about. But a naked call is basically you're writing a call option and you don't actually own the stock. So if you lose on that one, you got to buy the stock, and you can get in a lot of trouble doing that. So it's a really advanced way of doing it. And when you come to options trading, there's several strategies and several different types of options and all these different strategies, and it gets pretty crazy. So we're just going to focus on the simple a call and a put, which is what the video kind of went over. A call, basically, a long call means you think the stock price is going to go up, and a put means you think it's going to go down. So with options trading, the way the video explains it is at the end of the term, you have the option to buy it. So yes, that's how it works with stock options. But most people, I would say 99% of people trading options are not trying to buy the stock at a certain price. They're swing trading options. That option has value. So basically, you have the time. There's two components to an option. There's the time value and the intrinsic value. Intrinsic value is based on what the stock currently is. So if you're buying a call and the stock price is going up, then that option becomes more valuable because it's getting closer to what you think the stock was going to do. But there's also a time value, and as that time shrinks, the option becomes less valuable because you can't resell it. So the whole idea is that you're reselling these options, and you're never getting to the end to exercise the actual option. Because if you do that, let's say, okay, so with options, you have to buy 100 at a time. You can't just buy one. You buy an option. One option contract is 100 stock options. So you're basically buying the option to control 100 stocks. So let's say Tesla, if it's trading at 415 right now, times 100, that's 41,000, right? If it's 415 times 100, it'd be 41,500 to buy 100 shares of Tesla stock. If you buy the option, you might get those option for, let's just say it's like $7 per option, and you got to buy 100 of them. So to buy 100 of those for $700, you could control that $41,500 worth of stock as if you're holding it. So when it goes up, you would be able to capitalize on that without actually buying that stock. And then you're going to sell that option before it expires to somebody else who's going to try to do the same thing. And you're just going to take the profit because your option is now worth more if the price goes up. So let's say you buy an option for 475 by the end of the year, and you buy it now, and next month they have a good earnings call and it goes up to 450. Well, that stock price just rose $35. That option is now more valuable because it's closer to that 475. So somebody's going to be able to be willing to pay more for that option than you paid because it's a lot closer to that 475 marker now, or the strike price. So now what you do is you just sell that option, you get out of it, you've made your money, and then you're done with your trade. So you're never actually buying to run it out for the full length of the term, if that makes sense.
Yeah, and also that price will change pending what call or put you select.
Correct. So I'm going to share something else. And I'm going to give you a link, and I'll drop it in the comment. You can grab this. So this calculator is what I used to evaluate on all the trades that I did. And it's really cool because it will show you what your profit would be at different intervals. So let me share this here. Got too many windows open. I'm trying to figure out which one this is. Come on. Okay, it's this one. Let's get over here. Okay, do you see where it says options profit calculator at the top?
Yep, I see it.
Okay. All right, so this, if you go to this website, optionsprofitcalculator.com, there's all these different, there's the basic ones. We're just going to talk about the long call and a long put, but there's like credit spreads, which I used to do. Here's the covered calls talking about all these different strategies that you can do. But let's just focus on the long call. That's the most common and easiest to understand. So what you do to evaluate your trades, you come in here and you just put in the ticker symbol. So let's just do Tesla because I was talking about that. So we'll put that in here. Get price. Okay, so it closed today at 418.30. So this is the current stock price as of right now. So let's say we want to buy. Okay, so we're not going to write. We're going to actually buy the option. Writing would be as if you own the stock and you're doing a covered call or a naked call, but we're going to buy. And then if you click here for the stock options, this has two components to it. So again, there's the time and then there's the intrinsic value. So the time value is going to be these different dates here. And these dates are the Friday. So it's the closing date of the week for 1 week at a time. So they've got May, there's going to be three left in May here. We got, oh wait, I don't know why it says the 26th of May. Maybe that's today. If you buy one for today, the 27th is tomorrow, which is Friday. And then next Friday is the 29th. So then you got June 1st. That's weird. I guess they do the beginning, the opening. Yeah, I don't know. Oh, probably because maybe there's a holiday. I don't know. These are
Yeah,
supposed to,
Memorial Day.
yeah, it might be
Oh,
throwing.
no, that's the 20, what is it, the 25th? Because tomorrow will be the 22nd.
Yeah, I don't know. That's weird. Usually it's the
That is
Friday.
weird that
So
there's a
I don't know if there's a
26th.
markets closed in some of these days or what, but
Okay.
18th, 26th, July 2nd, 17th. So these typically are going to be on Fridays when the stock closes. So let's just say, for example, let's pick December, or let's go October 16th. It's my birthday. Good day to go. Okay. So let's just say we think Tesla's going to go up. Let's say our marker, we think it's going to hit $450. Let's say that there's an earnings call or there's a product coming out or something, and we think it's going to hit $450 by the end of June. I don't want to do this for the end of June because it doesn't give me a lot of time. I'm going to do it for the 16th of October to give me a few extra months, and then there's going to be some meat on the bone to be able to sell. Now, it's going to cost a little more because there's more time, and that time value is going to be baked into the cost of the option. But just to give you an idea of how this calculator works. So then right here, this middle right here where it says strike, this is the strike price. So this is the price that we're betting that it's going to go to. So if you scroll down these, and on the left side is your calls, okay, and then the left side and the right side is the puts. So we're working on the calls, meaning we think it's going to go up. So let's scroll down to where it's at right now. Okay, so it's got it right here. It says this is what it closed at right here. So you got it. You know where it's currently at. Okay, and then we're going to go down to 450 because we think that 450 is that's going to be our strike price. So we're going to be playing with a 450 bet. Basically, we're betting that it's going to go to 450. Now there's three columns here. This is the price that these options are currently trading at. So this is what people are currently bidding. This is people are currently asking. And then the middle of that is right here. So typically if this is what people are asking, this is what people are trying to pay for it. Usually right in that middle is where you're going to get it at. So we'll just use that as our buy price. So if you buy, so $40.63 means that it costs $40.63 to control one stock of Tesla. And that's about, it's probably right around 10%. It looks like roughly 10% of the value of the stock. So if we do this, again, we have to buy 100 of them. So it's going to bring your price in here and it's going to say one contract. So if you're doing one contract, that's times 100 because we got to buy 100 at a time. So the total cost of this option contract is going to be $4,063. So that's what we're actually paying. What that does is that gives us the ability to control 100 shares of Tesla stock without coming up with $41,500. We're only having to come up with $4,063 to control that stock and basically betting that it's going to go in the direction that we believe it's going to go in. Okay, so then you hit calculate here. And then you scroll down here. Now, the way this works, again, we got the time. So here's your time. This is the time value. And then on the left side, we got the intrinsic value, so the actual value of the stock. So today it's at 415. So let's go down to four. Oh, shoot. I forgot
No,
to do something.
418.
Yeah, I forgot to do this. Okay, so stock price range. So you can customize what you want this to show. So let's just go 400. Let's just say 400 to 500. Tesla kind of swings a lot. So we're going to do a bigger range. So we'll say 400 to 500, and we want to see the calculator output this. Okay, so then we go to, what was it, 418, 417, right around here. So this line right here shows basically day one break even, what we bought at, or the strike price that I'm sorry, the current price that we bought at. And we want it to go to 450. That's what we're betting on. This is going to go to 450. So you'll notice on the lower right, this is all red. So if you scroll over these, this shows you how much you're losing on your trade. And then the green shows you how much you're gaining. So again, we are betting that Tesla is going to go to 450 by the end of June, but we bought our option to go till October 16th. So if you go to 450, okay, this is what we are saying it's going to get to. And then we're going to go and scroll over here to June, end of June. So June 29th, that would be the Friday. So right here. So if it does hit 450 on June 29th or before, on June, if it's worth 450 on June 29th, $872 is our profit. That means we could sell that option that we have to somebody else that's now going to take their own bet and take that option contract that still expires October 16th, but somebody else is going to take on that bet. We can get out of it right here because it hit our 450 on June 29th. And so we can sell it to somebody else and we will make a $872 profit. So if you click that, it shows right here, $872 profit. So we paid $463 for it. And then this is what they would be worth at that point in time. And then we would sell it for this amount. And so our net profit is going to be $872 on that trade. So $872 is like, I think it actually tells you what your return is right here. When I scroll over it, let's go back to 29. %21.5%. So if we sell that June 29th, we just made a 21.5% return on that trade that we only held for 1 month. So if you did that 12 times, you're making that times 12 on your return. For context, most like the S&P 500 typically gets 8 to 10%. I know a lot of people have been getting closer to 20% the last few years on a lot of their funds and stuff, but that's per year, not per month. This is per month. So on this one trade, we just made 21.5% in 1 month's time. So you take the 21.5, multiply that by, basically 12, you'd be at 250% return. So this basically gives you the ability to protect, like as if you're sitting on 100 shares of Tesla stock without having to come up with $41,000 out of your pocket. So this is where options becomes, it's not leveraging necessarily because you're not actually leveraging and borrowing money, but you're leveraging the concept by controlling the asset for a very small fraction of what the asset would cost to just buy and sit on. So compared to just buying stocks and trying to make money sitting on stocks, you can see how this could be much more profitable. Because if you had put, let's just say that we are buying, hold on, 10 times 100. Okay, so let's say that same amount of money. So if you're going to buy the Tesla 100 shares of Tesla stock, it would have cost 41,500. If you put that into options and put 40,000 into the option instead, so you're now controlling it rather than buying the actual stock, here's what happens at that same interval. So let's say June 29th. So at that 21.5%, you make $8,720 without having to take on the risk of actually buying all that stock. So I just want to see what this will do. So if we had 100 shares of Tesla, 450, we bought it at, what was it, 418?
Yeah.
So it would have been $32 per share increase times 100. So it would have been $3,200. So if you had just put $41,000 and bought all that stock, sat on it for the same amount of time, you'd be $3,200 up. Whereas this, you're almost 3 times the profit versus buying the actual stock. Now, there is risk to it because if it had gone the other way and you ran out of time, obviously you lose money. So there is risk, and this is why you don't just put all your money into one trade on an options trade. But you can see that you're leveraging the asset to be able to get you're leveraging the strategy, I guess you could say, to be able to get a lot higher profit with the same bet or the same strategy that people will just buy and hold on it.
And earlier you did the math per year, but that's obviously only if you keep reinvesting.
Right. So let's say you take that, you sell that the 29th, and you just turn around, you do that again with that money. And then if you did that, once a month, you would, and if so in a perfect world, if you hit it every time, you could
Yeah.
get 250%, right? You're not usually going to hit every time, you're going to lose some, but sometimes, so let's take this back down to our original example. It's a little more realistic of just one contract. So we go back to the 450, June 29th, we were, there we go. $872 profit. Now, let's say that Tesla got to 450 before June 29th. So if we were waiting to June 29th, again, the value of that is going down constantly because we're getting closer to that expiration. So there's not as much meat on the bone to be able to sell to somebody. But if let's say it goes up by June 14th and we hit that 450 number, well, now if you look at it, if we dump that option after 2 weeks, now we have a $1,200 profit and then almost a 30% return because we're selling that to somebody else, and there's more time between now and October 16th, so there's more value left to it. So regardless of what the stock does, the options value is constantly decaying as you get closer to the expiration because it has that time. It's called time decay, because the shorter the time, the less it's worth because there's less time for that stock to go in the direction that somebody believes it's going to go in. So, you could potentially hit it in a day. I mean, if you got in before an earnings call and that earnings call happened, right after close, and then on Monday, let's say it hits the 450 over the weekend or something, and then you come in, you could dump that stock right away, make
Wow.
a 40% margin after 2 days. So,
How awesome would
again,
that be?
it could also go the other way too. So it goes both ways. If that happens, you still have time for it to come back. So this is why if you do lose on a trade, even though it doesn't hit it by your June 29th, now you actually still have time for it to maybe come back up because you bought it until the 16th. So it could still come back up into the green before that time. Or you could sell it at a loss. If you think it's going to keep going down, you're like, I just want to get out of this trade. Let's say at the June 29th, it drops or it doesn't go anywhere. Let's say it's still worth the same. So if it's still at 417 or 418, somewhere between here and 417 is closer, you could just get out of it and you're like, I think it's going to keep going down. I just want to cut my losses. You'll lose $823. So you're still going to lose money, but you're not going to lose your $4,000. You're only going to end up losing 823 because somebody else will still pay $3,000 for that because there's a lot of time left for that to go back up. And if somebody thinks it's going to go up, there's still that meat on the bone where it still has value. Now, if you get to over here and you've lost like, okay, here, you've got another couple of weeks left on it or whatever. This is like 2 weeks expiration. Actually, I think it's like, no, I guess it's like, yeah, 2 or 3 weeks expiration, and you've lost most of your money. It's still worth the same. You've only got $400 that you're saving. If you sell it now, you lose 30, 35, 60, you're going to lose $400. I mean, you're only going to save $400. At this point, it's like, well, maybe I'll just save it in case something crazy happens and it comes back up. But if you just hold it until it expires, then you lose all your money and it just expires worthless. You don't have to buy the stock. You're not obligated to do that because remember, you are buying the option, not the
Yep.
obligation to buy that stock. So really all you're doing is you're controlling the ability to buy that stock, but you're really getting in and out and selling that to somebody else because you're not actually planning on exercising that option and having to come up with that $41,000 to buy that stock at that price.
Okay.
So that's kind of in a nutshell how this works and kind of how, again, with options, with swing trading, you're getting in, you're getting out, you're not actually running it out. So the purpose of it having a longer expiration is because it has more value to be able to sell to somebody else and get you out of it. So let's just go, we can do the same thing for a put. So let's say, I got to go back up here. Let's go down to puts. So we're going to do a long put. So this means you're bearish on Tesla. Let's say you think they're going to hit a wall, sales are going to be down, whatever, and you think it's going to crash. Let's just do the same. So it's going to be the same price here because again, that's what the current price is. We're still going to be buying. And then let's just do the same. We'll go to October 16th. And then let's say we think it's going to go down to 400 by June. Let's use June 29th again. So let's see, 400. Okay, we'll go with the mid price here. So this is actually more expensive because right now there's more belief that Tesla's going to go down than it's going to go up. So that's why it's more expensive to buy the put. Well, actually, I take that back. The other example was, oh shoot, you know what? I was on the wrong side here. Okay, forget everything I just said. So
You
a
want, you want,
$400, say we're doing a $400 put, we need to come over here to the put, not the call. Okay, so 38. So it's actually about the same dollar amount to buy that put going down. So that tells me that it's more expected that Tesla's going to go up because the put we were only going down $17, whereas the call we were going up like 35. So
yeah.
it's more likely, or it's more it's I guess the market expects it to go up in that time frame more than expects it to go down. But it's the same concept with this. So let's do we'll just do 400 to 500 here again and run this simulation. So because I did 400 here, so it's only going to show. So basically, in order to make money on this one, June 29th, so this actually would not make much money. So 400 is not a good marker because on June 29th, you're almost breaking even at that point. So it would have to go down a lot sooner than that. And again, the reason is because it's expected that Tesla's going to go up, not go down. So that's why you're not seeing as much meat or as much profit on this.
Who or what dictates that? Is it obviously just the market, and then that's why you use a
It's just
calculator
it's
to
just
figure this stuff out before you go for it, right?
Yeah, it's all perception. So this calculator has nothing to do. It doesn't know the market. All it knows is what the current prices are, and the price is what dictates where the market's going. So if you go back to uh, right here. Oh wait, no, wrong one. Select here. So this is what dictates where the market's going. So right now the calls are more expensive because there's more belief in the market that Tesla's on the way up, not on the way down.
Mhm.
And so it's really the price. It's all driven by, supply and demand drives this. So there's going to be more people that are trying to buy these calls because they think it's going to go up, and so these are going to be more expensive. Now, people, you hear of like short squeezes and things like that. That's where people will try to do a put and try to cause a stock to go down. I mean, this is like, if you ever watch Billions, where they'll try to like manipulate a stock because they've got a short position on it. So they're buying puts and they'll try to get the stock to go down by short squeezing all the people that are going the other way, right? So then you got a play on the market. That's illegal stuff and trying to manipulate pricing. That's people that have a lot of money to really
To
like
do that.
manipulate markets and do stuff like that. But basically this pricing is kind of determining, you can kind of see which way the market's going or which way the market perceives that stock is going to go. So that in a nutshell is how options work, and again, why they exist and how you can make money on it. But again, we're not trying to hold this because we don't want it to hold that stock until, well, actually, you know what? Let me go back. Oh, I must have clicked something here. Uh-oh. I don't know what happened. Okay, let's go back to the original one and say that we did the Tesla. We're buying. Go back to our same one. It was October 16th, and we said 450. Okay. By 4 to 500. Okay. So let's say we're holding on to this option and it gets to here and we're starting to lose money now because we are saying again that's going to go to 450. Now, this right here is showing, well, yeah. So let's say it hits the 450, okay? Um, and but it doesn't hit it till after here. So we're in the negative here. You could realistically get to this point, it's at 450. You could buy the stock if you wanted to, if you think it's going to keep going up, like keep going up more. You could buy the stock, but there's really no point in it because you've lost the money already. Now, if the stock price, let's say it's at um go all the way up to like, actually, yeah, it's not going to 500. Let's say it's at 468. Okay. And your option expires. Your option, you've lost money on the option, but you have the option to buy that stock if you want to come up with the 41,500, because you can buy the stock at $450, which was your strike price, but it's now worth 468. I don't know if it actually, it probably doesn't even make sense. Let's see. So you'd make $18 times 100, $1,800. It comes out, yeah, okay. So basically it's the same thing. If you were to buy the stock, it's the same, it comes out to the same number here. So right here, you lose 2263 if you were to buy the stock. So basically it's showing, okay, you let it expire all the way to the end. So your option to buy the stock, because you're buying that stock under market value, and then you could turn around and sell it and make that profit. So you could run it all the way to expiration, and depending on where that stock price is, if it's above your marker here, you actually still make money. So if it's at 450, which is your strike price, and it expires, you just break even. But if it's worth anything more than that, you have the option to buy that price, the 450 price, so you're actually are making money there. So if the price goes up to like 500, even though you let it expire, you still end up making money. Same thing here.
But
If
you
the
have to
price,
buy it.
you have to actually, I don't even think you have to buy it. I think you can just cash out on the difference on it because you have the option to. It's like, oh, well, just pay me the difference. I don't think you actually have to buy it. You can, but I don't think you have to. I don't know. I've never actually let it go that far. So I've never done that before.
Okay.
But the other thing is, let's say again, June 29th. And remember, I said like if the price goes up, let's say it goes up to like all the way to 498 at June 29th, now you're really cooking because now you have more than hit your number well before or way ahead of where you thought it was going to be. You can really cash out on this and almost double your money on that same trade. So if the stock just shoots up, let's say it shoots up before that. The earnings call at the beginning of, oh shoot, sorry, I'm not too far over. That was June.
Mhm.
So yeah, so it goes up so you're basically doubling your money. But let's say at the beginning of the month when it hits that, you could actually get out even higher and just dump it right then. There's no reason to keep holding it till June 29th or any time. Might as well just dump it and get out of it. Take your big one. Again, you can go the other way too, but this is how you're able to just control that asset. So when you're getting into trades and you're getting you see a 3 month expiration, you're never going to hold that for 3 months. The whole idea is that it's going to go up sometime between now and then, and you're going to sell that off to somebody else so then they can do their thing. Why would somebody buy a stock that's getting close to expiration? Because it's cheaper. Because remember, there's time decay value. So let's show an example of that. So let's say instead of October, let's say we are doing, let's see, June 26th. And let's go to our 450. So it's only 1175. So now to control that same stock, you're just paying a little over 1,000 rather than 4,000. But it's because we don't have as much time now. We're not going to October, so there's a lot less time to get to that number. So you can see the time, $3,000 from the end of June to the end or middle of October was worth $3,000, and that was the time value of that stock or that option. Does this help kind of break down and see where these numbers are coming from and how it works?
How they dictate and how, yeah, it's good having a calculator.
Yeah, so this is like super useful because you can just like before you jump into a trade and you want to see, okay, well, what if it doesn't go up? When can I get out? Like, and you can kind of see and know, okay, this is when I want to get out, because you can just run this through and be like, okay, if it hits this or that, and like, and really see and kind of build your confidence in the trade that you're doing. But this is kind of nice because it gives you a visual to see exactly what that's going to be worth at any given time.
Yeah.
You know, and two, if you don't hit it by a certain date or if it starts going down, it kind of lets you know, well, based on how much time you have left, this is how much time you have for it to come back around and maybe still break even on the trade or still make money on it.
And then I know people sometimes set up kind of where they would want it to draw, like set limits for themselves. And I'm guessing you can do that with all this too, right? Like say to if it goes -10, -20, I don't want to hold on to it anymore. What do you do?
Yeah, so that's going to be on the trading platform that you're using. So that'd
Okay.
be kind of like the same thing with the stock. So you're going to have a sell price, like you're going to set an auto, basically like an automatic. I don't want to lose more than this if it goes negative this much, or if it goes up this much, I want it to just automatically sell and take my
Exactly.
win.
Yeah. Say like, oh, I'm okay if, it would have been I don't know if it's gonna get up to 40, but if I'm okay with 20, I could just set it to automatically go out at 20.
Yeah. Yeah. So you can have it in that way. You're not having to watch it, manually and get it in there. Just, hey, this is what I want. If it gets to this number and it gets my 20% or 30% or for whatever it is you're trying to hit, and you can have it automatically sell. So you can set those auto triggers. Then it takes the emotion out. So then you're not emotionally, because
Yeah.
that's the part like with trading is you got to be able to take the emotions out of it because people, it's an emotional roller coaster. And so a lot of times people will get stuck and trapped into that emotional roller coaster. If it starts going backward, they want to get out, or like even though we know that it goes up and down, we know that's not how it works. Like psychologically, you get trapped in that emotional roller coaster. And it's like when things are good, you want to buy, when things are bad, you want to sell. And again, with options, you can go both ways because you can buy a put. So it doesn't matter which way the market is going. If you're buying that Tesla stock, you only want it to go up because it's the only way you're making money. But if you're buying options, it could be, Tesla's going down. You can buy puts now and you can make money on a stock that's dropping. So it just gives
Mhm.
you a lot more options. It doesn't matter if you're in a good market or bad market, there's always going to be um, a way to make money with options trading. You make the most. You see the biggest swings when the market is really volatile. So right now it is with everything going on. So when there's a really volatile market that's like one day it's really up and one day it's really down, everything's moving all over the place. It creates this momentum or these opportunities with options because quick stock movement is what makes you money quicker. You want it to go up or down based on which way you're doing. You want to do it quickly because you want to get in and out as quick as possible because of that time decay. You want to sell as soon as you can, as soon as you hit your number, because the longer you wait, the less value that option has because it has less time before the expiration. So a volatile market is actually really good for options trading because of the big swings and the ability to get in and out quicker and have higher returns.
Yeah, I could see that. That calculator definitely paints that picture. So that's the trick is maybe go kind of go long, but planning or expecting to do it sooner, like you said.
Yeah, so like the longer you go, the more time it gives you to be able to exit it and hit wherever, hit your win, whatever, whether it's up or down. But you pay more for it. So it costs
Yeah.
more to get into it. The longer the expiration, if you buy something, you can buy options for the same day. Tomorrow's Friday. You can buy one that expires on Friday. So you can buy a 1 day option, buy it in the morning because you think it's going to move a lot for whatever reason.
Mhm.
You can sell that option before expiration. There's still people buying that, trying to make a few pennies before the end of the day because they're buying a bunch of options contracts. At that point, you start getting down to pennies. It's not $10, it's down to like pennies, and they're just buying a bunch of them and they're still making money until that expires. That option is still being traded back and forth, and somebody's making money on it until it completely expires.
Obviously, you gotta have the time for that one.
Yeah, well, and I mean that's all like auto. A lot of people have those auto trades, I'm sure, but because you're in and out pretty quick. But yeah, so there's people that are looking for just pen movements by penny. So they're getting an option for 10 cents, and they're hoping the stock moves 50 cents, a dollar, in during that day, and they're going to make money still. So
Wow.
it gets down to like literally like until that expires on that closing or that expiration date you have until close, the market close of that day before that option is worthless, and people are trading all the way till the bell rings.
And those would be more or less. Sounds like it would be less because it's sooner.
They would be, yeah, that's what I'm saying is that option that
Yeah.
we're seeing now that costs, $10 would cost pennies. You can buy
Yeah.
it for 10
Okay.
cents or whatever because it doesn't have that much. Like it's got to move today. So,
Interesting.
and it depends how far, even though, so if the stock is at 418 and you want to go to 450 by end of tomorrow, like, well, that's not going to happen. It still has some value, not much, but again, we're talking like pennies now. So now
Okay.
people are putting in, maybe they're buying 100 contracts or a bunch of contracts to make it bigger values, but there's still movement. So if the stock goes up $10 during the day tomorrow, then that option is still worth, that call option is still going to be worth more by the end of the day. So,
Okay.
so yeah, so people are trading this stuff until the bell rings. So when you have a 3 month contract, again, you're not holding for 3 months. You're trying to get it out way before that and sell it to somebody else that's going to make money. I mean, that option is going to trade a whole bunch of times before it actually expires. I mean,
Hmm.
there are people that would sit on it, but that's not, the point of swing trading is you're not holding it till it expires. You're just trying to get a win and get out of it and turn around and then do it again.
And swing versus day is obviously that the swings take a little bit longer. Day is you're in there every day.
Yeah, so like the day trading, you're buying that one tomorrow morning and then you're getting out of it by the end of the day. And you're just doing a same day trade. Whereas swing trading, you're buying that for, that October 16th deadline or expiration, and you're planning on getting out of it by June 29th. And so
Okay.
that's a swing trade. And swing trade could be a couple days, it could be a couple weeks, a couple months, it could be really anything. But you're still trading and getting out of it before it expires.
So we keep going to like June 29th as an example. So we do that because we did that sort of just mentally, or like how do you pick a date?
I was just using that as an example because
Okay.
let's just say we thought there was an earnings call during the month of June, or they had a product coming out, or whatever reason that we thought it was going to go up. But it's really, if you go back to the example, you can see there was a bunch of dates every single week, and then there
Yeah.
are all the different strike options. So there's a ton of options. Now, when you go, this calculator doesn't show it, doesn't show the volume, but your trading platform will usually show the volume, how many options contracts are available, because there's that date and there's that strike price. So the farther in the future that you go, the less options you're actually going to see, because those options don't exist unless somebody actually does a covered call or naked call and actually puts that option into the marketplace. So there's kind of parameters based on the supply and demand, or based on the supply, I guess,
Mhm.
of what's going to be like. You'll see there'll be certain options and certain strike prices, especially closer to the existing strike price. There's going to be more options written in that. When you get farther up or farther down, you're going to see a lot less options. So there's some options that wouldn't even be available if you wanted to go like, to middle of next year. You're probably not going to find much. There will be people that write it, but you probably won't see a whole lot, because that's so far in the future. People aren't writing that because so much can happen between now and then.
Well,
So there is a limited number of options available, but there's still a lot.
okay.
Any other questions, or does it kind of give you like a better grasp on it and understand the strategy of how to get in, get out, and why
Yeah.
why you're
Yeah.
getting in, getting out?
That's why I was asking about the dates because I'm also thinking of just percentages. And that's another way to go by too. Or if you set up, whatever app you're using to do that, just looking for easier ways to do that, to plan, to strategize. So,
Yeah,
uh,
because you want to figure out what your strategy is in terms of like what's the return you're trying to to get. Like what is it you're trying to get on each trade? So let's say the average trade you're in and out, you're in for 4 weeks. So you're in a trade for 1 month, which might be kind of long. I think usually most options you're in and out of in a couple of weeks, but it depends on what
mm,
the stock does. But let's say it's 1 month is kind of your average exit, and you want to try to hit 20%, um, on as an average on your trade. So let's just say, for example, you have a certain amount of money that you're trading with, and I wouldn't put all your money into one options trade, obviously, but let's say you're doing 10%. I think that's usually like a good guideline, is you're doing 10% of your trading amount into each trade. So you've got 10 trades going at once, and they're all cycling through once a month. Let's say your marker is that you want to hit 20%, a 20% return as an average. So you're going to lose some. Some of these you're going to end up losing on. You're not going to hit all of them. But let's just say, you get 40% on one and 50% on one, and you lose 20% and you lose 30% and hit, you want to try to hit more than you're winning, obviously, or higher wins than the losses, but try to strategize so that you're hitting your whatever your marker is. If it's that 20% return per month, which is really incredibly good, but if you can get that, and especially with the strategy that you're doing with the copy paste, that was with Cam, if you can hit 20% per month, I mean that's incredible because you multiply that by 12 months. That's huge returns. You can almost 10x your money in 1 year doing something like that. Again, you could also lose all your money too. So I'm not going to say not saying it's a surefire way to
Yeah.
make money, but if you strategize and again, don't get caught in the emotions, like when you're losing, like know when to cut your losses. So if you are in a trade and it hits, 15% below and you don't think it's going to rebound, sell, get out of it, take the 15% loss, and then try to offset it with a higher, with more wins and keep that average
And
in
how do
the positive.
people, yeah, how do people pick the stock, the ticker? You just kind of,
I'm not very good at that. So when I was doing it, I was glued to the screen all day. I was on Twitter. I was following like the FANG stocks for the most part and Tesla. And
Mhm.
I was just watching for little things like news and articles, like, cause a lot of those tech stocks, especially in a volatile market, like a news article that comes out on anything will make a big difference on a stock and it'll start moving.
Yeah,
So I was watching it, but once I started getting busy with work, it was like I couldn't do that, and then I started losing money, and I'm like, okay, I can't do this anymore.
stay
I
informed,
was,
stay informed.
for a few months I was doing it. I was making, I think I was making like $5,000 to $10,000 a month in profit. I was winning more than I was losing until I stopped paying attention and I started losing more than I was winning. So I stopped doing it. But I am going to start doing it again using, Cam's program, and because now I don't have to watch it as closely.
Yeah,
Or if you do if you get hooked in with the automatic trading, you don't have to do it at all. And you can do day trading and swing trading, and it's just automatically trades with what they're trading. So you're not having to come up with it. But I wanted to make sure you had a good understanding of how this works and why it works and the concept of options trading. Just it's the idea of being able to control a large amount of stock without having to have the actual money to buy the whole stock. So
yeah, yeah.
you're not tying up $40,000. You're controlling that $40,000 in stock with only 4 grand.
Yeah, those are good examples too. In the beginning of that video, I kind of relate more to the car one.
Yeah. Yeah.
That was good.
Cool, man. Well, any other questions? Hopefully this helps like kind of narrow down, get you like a
Yeah,
good concept and understanding of it and helps like kind of shape your strategy on how you want to move forward.
yeah, I think so. Absolutely. So yeah, thank you for that. For taking time.
Cool, man. Well, have a good one. That is it. And I should probably say this at the beginning, but I am not a financial advisor. This is only for educational purposes. So don't take anything I like. Don't come at me if you lose money, basically.
Yep, yep.
But yeah, I think with Cam's strategy, I really think that it's a good play. I think they know what they're doing. He's got some good people on the team that are doing glued to the screen all day and looking for these trades and knowing what to buy. So I really think that it's a good strategy. You need to know how it works so you understand
Hmm.
how to make money on it.
Yeah, exactly. Well, cool. Got it.
All right, man. Kick some butt.
Yeah,
Keep me updated.
I will. Thank you.
All right, have a good one.
You too.
Later.
Bye-bye.